Good afternoon, everyone. Thanks, Kesha, for the introduction. I thank Mate for having me over for this session. I've been working with Mate closely since the last 8 to 9 years on different taxation issues. And we're also working closely on our hot topic, which is the topic for the day, which is GST. So what I propose to do in the next 30 to 40 minutes is to walk you through a few slides for us to be able to understand the framework of GST in the context of the IT hardware and telecom sector, talk a little bit about where we are under the current regime, then we go into where we actually stand on GST at an overall level, and then get into, because somewhere as we progress into this conversation, we'll realize that GST is no longer a matter of if it's really a matter of to that we will try and understand what is the impact of GST on manufacturing, trading, and services, and then get into a little bit more detail on business, what does it mean for us, and collectively, what do we need to do to go back to the government at the stage when they're understanding the law as well, because it's a new law, to be able to come out with a law which is not only good on paper, but also easy and effectively implemented. So for us to appreciate the dynamics of GST, it's first important to understand what are the current set of levies that we have under the law. The current set of levies we have is a state and federal system of taxation. This goes back since 1950 itself, since the Constitution of India, where the state has a set of taxation powers and the center has another set of taxation powers. So to be a little more specific, the center levies a tax on manufacture of goods, it levies a tax on import of goods, and it levies a tax on services, which is a service tax. Now, for let's probably deal with the most important, or the one of the points which is relevant even under GST or going forward, is the basic customs duty. That is a duty that will continue to be levied, and that is not a transaction tax per se. So that the entire GST gamut, the conversation, the constitution bill which is underway on an amendment, has nothing to do with basic customs duty. So that particular levy continues. Now, what therefore will remain other than the basic customs duty is, as you see on the left side of the slide, is excise, service tax, and some of the elements of customs duty that are in lieu of excise and VAT. On the right side of the deck, you may notice that the state levies, and states have effectively levied tax on sale of goods, which is VAT and central sales tax. They also have a tax of entertainment tax, and some other taxes like entry tax, luxury tax, and others. So, but what's more relevant to us is from a day-to-day operational basis is VAT and sales tax as well as entry tax. So if I pause here for a moment, as far as product companies are concerned, the product is either manufactured or imported. That attracts an excise duty, which is levied by the center, and thereafter, as the products go through the chain of sale, you have what is a VAT or a central sales tax, and therefore a distribution tax. So a product today suffers both a central and a state levy, but you and I, wearing a hat of a consumer, we walk into a store or we buy a product, we only see the VAT element, we do not see what is the inbuilt excise element. Similarly, service tax is only a tax on services, and the states until now have not had much to do with it. So today, if you look at your telephone bill, you have a bill of, say 1,000 rupees, you have a service tax of 14%, and that's a tax that's paid to the central government. The state government does not levy or collect that tax. So what's going to happen under GST, and I've got a lot more detail, but at this juncture, it's just worth to note that other than basic customs duty, all of the transaction taxes that you see in this particular slide will get subsumed, and what we will have is a GST. Now, we're not a plain vanilla GST. Now let me try and explain those two little lines of phrases there. What you see on the screen, one is a CGST and the other is an SGST. Now, why do we need to have that? Why couldn't India just have one India GST? The primary reason is that GST is replacing taxes which were collected by the center and state, and therefore states do not want to let go of the autonomy of levying a tax on transactions, and therefore they would like to collect the taxes at the stage of collection itself, rather than having the central government collect taxes for all states and back end distribute. It would get very complicated, and that's why the government has never tried meaningfully to have a consolidated GST, and that's why we have what is known as a dual GST. Is dual GST common? The answer is it's none countries like Canada. Now, what happens, therefore, we will go into how an invoice will look under GST, but it's just safe to say that on every transaction of sale of goods or services, you'll have both the elements of what you see as CGST and SGST that will apply. And we'll talk a little bit more as we discuss as to how are these two elements relevant, how does the SSE pay the tax, so on and so forth. Before we get into understanding GST, I thought it worth to just recap what are the nuances of of the current tax regime. So the current tax regime, if we look at our excise products, excise duty is currently at about 12.5% for all products, and we have a lower rate of VAT for IT hardware. Lower rate of VAT has emerged since 2005, since when states introduced a VAT in place of sales tax. There was a general consensus to have a lower rate of VAT on select products, and IT products have always been in that lower rate since 2005, I'm sorry. Now, that rate was 4% when we started off. That rate then nudged up to 5 and 5.5 in many states. Keeping that the details around why is it 5 and 5.5 aside, what we have noticed in the IT hardware sector has experienced is that we've noticed that the lists of what constitutes to be an IT hardware are not necessarily the same from one state vis-a-vis the other. So we've had cases where a particular product can get disputed that in one state the authorities are allowing it to be a lower rate of tax, but the other state they say, hey, it's not an IT hardware product. So that is really the reason and rationale for that is very simple, that the list of products are not in a very detailed form and without an HSN in some states, and those have resulted in litigation. To give you a simple example of a matter that's been under subject matter of several disputes is what happens to toner cartridges. Are they parts of a printer or are they consumable of a printer? Because if they're parts, they get in a lower rate, but if they're consumable, they will attract a higher rate. Another product that's been matter of intense debate and dispute is what happens to a multifunction printer. Is that a printer which is primarily used with a computer, or is it a printer that's primarily, used as a photocopier? So these are things that have resulted in some disputes. Be that as it may, I just wanted to raise leave one thought behind on this particular point, that historically there have been tax disputes around classification, and hopefully under GST we'll see that go away, and I'll come to what is the expectation of industry around that. Excise exempt zones. So some of the players have gone and set up manufacturing plants in excise duty-free zones like Himachal Pradesh and areas around that. And what that does is that the clearances of goods from those particular plants are exempt for excise, and therefore in that sense they get that competitive advantage. Now, any which way, that had a sunset of about 2018-19, and therefore we don't expect that to be a large issue going forward under GST, because when GST was being talked about, the entire issue was what happens to the fate of the promised exemptions to units in these excise exempt zones. So I think that's one part, but I think what we all will relate to better is a 1% rate of duty for mobiles and tablets that has been brought in the last couple of budgets. Tablets was extended in the last budget, mobile was there the year before last itself. And what this does is that if a mobile phone is manufactured in India, effectively the duty cost that gets incurred is just 1%. Of course, there's another 1% cess, I'll pass that aside, but for tablets it's again 1%. So in a sense, the government has given a benefit under the Make in India scheme, which is a pet project of the current government, to encourage manufacture of these products by encouraging and giving a concessional rate of. One needs to wait and watch how this will pan out under GST. Again, I will come into the GST implications of some of these, but I just thought it worth for us to recap some of this before we deep dive into GST. The other important feature of the IT hardware sector, and if we look around many of us who are into IT hardware in India, it's not predominantly been manufacturing. I mean, the government's been wanting manufacture to happen, but there have been some challenges. So yes, there is, challenges around manufacture in India, and those challenges have resulted in manufacturing not really taking place in the size and scale that we would have wanted it to, and the government wants to. Historically, there have been inverted duty structure issues There are also an issue that you can have a plant only in one state, obviously, and then you'll have interstate supplies that have a CST tax. So without going into great level of detail, the current taxation framework has resulted in some level of pushback for companies who, though wanting to come into India and do manufacture, they feel that if we come into India and do manufacture, or rather they believe and realize that there will be certain tax inefficiencies. Hopefully, GST will address this. Again, I'll come to how. Service exporters have traditionally wanted to buy goods directly from out of India because that has duty-free exemptions and VAT exemptions. So the landscape of, what we've talked about, the last bullet is what I talked about how the rate of tax is not uniform across states. But the landscape of IT hardware has been seen over the years to be quite consistent, that manufacturing has not happened in the scale that it can potentially happen. The demand supply dynamics have been driven also by other set of exemptions that the buyers have. Next, coming to the telecom sector. So telecom sector, let's just for a moment, when I talk about these 3-4 bullets, so the first couple of bullets, I'm looking at the telecom sector more as a service provider. So let's say I am one of the mobile service operators. I have an output service tax liability. In the previous slide, you saw the service tax liability is a central levy and not a state levy. So you're not entitled to get a state credit. So if a particular product is bought, like a capital good or a tower, the VAT that you pay on that is not eligible as a credit. So currently, there is a flaw that central tax is not available as a credit for state and vice versa. In addition to that, the telecom sector has seen its set of issues around credit eligibility under excise for capital goods, debate on the outsourcing contracts, where typically you have towers, that is, the towers which you engage in contracts with companies that own the towers and let them out and let the space out to you. Because if there's a VAT that applies, the telecom player does not get a VAT credit, and if a service tax applies, a service tax credit is available. But anyway, I don't think the tax position is so much driven by the credit being available or not. The factual position itself, if it's a lease or not, has been debated in the past. Moving quickly, I think on the SEZ side, without too much detail, this is a policy which is meant to encourage manufacturing zones for export out of India. But there's been this constant debate there, how do we even encourage these companies to use their capacity for manufacture in India? There have been some issues around domestic manufacture of telecom products. I can get into that in the Q&A if some of you have a question around that. So before we get into the detail on GST, the slide that I have before you summarizes where we are, because the first question that comes up is, okay, we are talking about GST, but is it going to really happen? We've been hearing about it since 2009. So as I summarized, the position on GST right now is that it's pending before the Rajya Sabha, the upper house of Parliament, and it's not yet gone through that. The government had nominated the report to be sent to a select committee. The select committees provided the report, and there was an expectation that in the winter session of Parliament last December, the GST bill would go through. Unfortunately, it did not go through, and it was, for want of a better, to summarize the reason in brief, there was sort of lack of political will and consensus. The opposition wasn't in consensus with the current draft. The opposition has really raised 3 points. They've talked about bringing in an 18% cap within the constitution bill itself. They've talked about abolishing an additional tax and also getting a tighter and a more robust grievance redressal mechanism whereby states will be forced to, or rather will have a tighter, there'll be a tighter rigor on states to ensure that they don't deviate from the GST, framework. So I think the current government has come out in the open and saying that the first and the third last point of additional tax and the redressal mechanism will be dealt with. They've, however, said that getting an 80% cap or any number for that matter in the constitution bill is quite unprecedented and not suggested. So with that, I think we do see that there's some level of headway of addressing 2 out of the 3 large demands of the opposition, but only time will say whether it will come up in the, whether it will go through in the upcoming session of session of Parliament, which is expected in the last week of February. Yes, there have been sound bites which I'll highlight in my next slide. that there seems to be consensus building, and also from a political, without getting into the details, the Rajya Sabha, the numbers for the members therein changes next year, changes this financial year in April. So even another aspect to be kept in mind is that possibly after April, it may be easier for the government to go through this. Without going into the politics behind it, I think there's still a reasonable expectation that there's a good chance it would go in this budget session in February, March. Otherwise, in all likelihood, the government may push for a session early April or May, not wait till the next monsoon session of Parliament and try to push this through. What I could only share with you a little bit more is that our involvement through MATE and through others has suggested that the government at the back end has been putting in all their efforts by putting in teams both from the central government side and the state government, and they have been we call the Empowered Committee. I understand that the drafting committee has met more than about 55 to 60 times in the last couple of years, and the draft GST as part of what bill is underway. So because one end, we all keep hearing about GST and the bill, the other thought that comes up to us is that is enough action and enough effort happening back end, because only that will give us the comfort that, even once the button is pressed for going ahead with GST, will we have a fairly detailed GST law, because as we progress, we'll understand it's quite a complicated law, to say the least. The answer is that yes, it is. There is a fair amount of effort, and we understand that the government is aiming to release this mid of February, towards end of February, the draft GST bill, because industries, including MATE, have been clearly saying that we would like the bills and the draft laws to be shared with us in advance, for us to be able to understand this better and for us to work on the inputs that are provided, so that then we can gear up ourselves for a meaningful GST next year. Just moving on to the next slide. Here are some of the snippets that I just gathered in the last month. Whether it is the president urging in early passage of pending bills, including GST, which he mentioned during his presidential speech on around the Republic Day. We also then had the opposition, some sound bites from the finance minister and otherwise. So these points are there in the slide deck, and that you'll have access to. But net, what is emerging is 2-3 things. The GST and back-end network seems to be a fair amount of work that's been going through, and I think that the IT platform, which is the most critical for the government to get right from a tax compliance and efficiency perspective, it's in a fairly advanced stage, 1. 2, even as far as the drafting of the GST bill is concerned, we understand that that's also in an advanced stage, and I just think that a lot is just left on the suspense of whether it will go through in this session or not. 1% additional tax, I think the consensus that's emerging is that will go away, and quite welcome by industry mates. One of the first top 5 recommendations we had on the framework was for the government to avoid this additional tax, because then it's sort of again bringing in a tax between interstate movement of goods. So in terms of the framework, and now I'll just explain that aspect of 1% tax. But before that, I did talk about a dual GST framework. Every supplier will have a dual GST. Now, let's, for a simple illustration, and I have a number in the next slide, say that there's an invoice for 1 lakh rupees. The total rate of GST is, say, assuming 18%, central GST at 9%, and state GST at 9%. If I go and buy a product out of a store that sells, say, a laptop to me for 1 lakh rupees, there will be a tax of 9% central GST and a 9% state GST, and my invoice will look like 118,000 rupees. So I'll again come to that illustration and how will it work for an interstate transaction. But for now, if you just relate to a local transaction, which is a last mile sale, that is how the next point is what is going to be taxed, because historically sales were taxed, services for a consideration were taxed. So the concept we're moving away from is a sale and a service. It's more a concept of supply for a consideration, with some level of exceptions for supply not for a consideration, and that's something that will also get taxed. I won't go into great level of detail on stock transfers getting taxed because it's a little technical, but it's just fair to say every movement of goods will attract a tax, and every movement of goods will require SSCs and industry to map the transaction in in a great level of detail to be able to demonstrate and their record keeping as well as their reporting at the time of audit and assessment by the tax authorities. The next point is on interstate supplies and imports. Really the issue there is that, we have the current proposal is that IGST will apply. So let's just say that I have a transaction of an interstate transaction from state A to state B. How will I pay tax in state B? Now, the point is that I can either go take a registration, in state B, which would have been one method, or the other, what the government has said is that, no, when there's an interstate transaction, keep it simple, that seller A is selling goods, say, from Bangalore to a customer in Chennai, which is Tamil Nadu, you have an interstate transaction, let the seller charge the tax of IGST, and this will allow the buyer or the distributor in state of Tamil Nadu to claim the full credit. So in some sense, every transaction across the local and interstate will have a full GST. While I'll explain in the next slide how the GST credit system will work, it's just fair to say and in this moment that the concept of GST will be that every transaction in the supply chain will have a GST. We will move away from the concept of a Form C. We will move away from a concept of a Form F. But at the same time, we will see tax on every transaction through the supply chain. A rate of tax, I think this is an important one, that it could vary for goods and services, but based on the last revenue report, neutral report by the Chief Economic Advisor, the consensus that is emerging is that services and goods ought to be at the same rate, but there will be some set of goods that may merit a rate of duty, which will be called a merit rate. Some products like luxury cars, alcohol, tobacco will have a demerit rate as well. But largely goods and services will be at the normal rate. But the question mark that remains is that, as I mentioned in the first slide, that IT hardware has typically been at a lower rate of VAT. So will we get into the merit rate of GST? Clearly, as industry, we would expect that we hopefully will get the benefit of the merit rate even going forward under GST, and that's probably one of the points that we may want to put into our list of advocacy points with the government when we engage in conversation. The next point to note is, services is defined as means anything other than goods. We need to watch the space as to how will we be treating AMCs when a local supply, interstate supply. That's something that we're not quite clear. What happens to transactions that are a service transaction that involves capex or goods to be used? How does the credit mechanism pass? I'll not go into great level of detail, but it's just safe to say that if that services and goods definitions become very important, not only from a rate perspective, but from also to decide whether a particular transaction is a local or an interstate one. Last but not the least, there was a 1% additional tax proposed in the draft GST Constitution Bill. This would mean that if in that A to B example, and I'm going to go into the illustration in a minute, what would happen is that there would be a 1% tax, which would be a non-creditable tax. This again would mean that you're going back in time and you're again having a cascading tax on the supply chain. Again, companies would wish to set up their logistics across the country, not only based on what is efficient from a business perspective, but also from a tax perspective. So with that, I think this recent announcement of the additional tax being scrapped is indeed a welcome one, and we from MATE will also welcome it, because this was in some sense was ensuring that we're getting into, or resulting in us getting into, a not so pure GST. So I did talk about the example, and the example is there for us to see right now, that if we have a supply of goods within a state, we have the central rate and the state rate mentioned therein of 9,000 and 10,000 respectively. What I've assumed here is Karnataka may have the option, or states will have an option to not just follow one particular rate. Now, we don't know the fate of that, because that's another ask of the opposition, that please do not allow this band, let all states just have one state GST rate. be that as it may, while we don't know the fate of it, the local supply of a product could attract 1 lakh plus 9,000 plus 10,000 in this example, and the interstate supply hopefully will just have one simple IGST rate rather than different rates depending on the state that you make the sale. So you have 18,000 and as well as you have 1,000 in this transaction. Please remember that if the 1% tax were to go through, it's not a creditable tax, and therefore credit of that tax is not available in this example in the state of Delhi. So while the laws are expected to, each state is expected to have its own act. So it will say Karnataka GST law, Tamil Nadu GST law, West Bengal GST law, so on and so forth. There's an expectation that the fine print of what is a sale, what is the service, what is the place of supply rules, etc., will match across all states. So the credit mechanism, I think, as you may notice in this particular screen, that the credit mechanism is, going to be that you have an IGST, you have a CGST, and a SGST. This credit is offsettable against one another. Then, as you move forward, the IGST can be offset against any of the three taxes, and the CGST can be offset against CGST and IGST only, and state GST against state GST and IGST. So in some sense, if you ignore IGST, the central and state taxes can be offset only within their own regime of central and state respectively, and the IGST is like a joker in the pack that either you can use the credit on the input side or on the output side. But what this definitely does, and it brings out an onerous task on us, let's say we have operations in 5 states. We effectively have 5 credit pools, 5 into 3, which is about 15 credit pools, and we have 15 output liability pools as well. And then you also have central and VAT credits expected to transition on the state. The transition part apart, before that, I'm just trying to raise the emphasis and importance of us going forward. If, let's say, I'm a service provider, I have, let me take a step back. I'm a trader. I have operations in 5 states. Then I have 5 taxes. It will be a local sales tax or VAT in state A, B, C, D, E. Going forward, I will have actually these 3 elements in each state. Now, let's paint this picture what happens to service providers. A service provider, like a tax consultant like myself, a telecom player, an insurance company, all of them, or IT companies, typically have one service tax registration. They charge the entire their service tax on one bill. They don't really care if the customer is in state A, B, C, or D. They normally registration and discharge taxes. So they have one tax assessment officer. If there's a dispute, there's one audit, one assessment. But under GST, each state, the current thinking, as we understand, is each state will be viewed separately, and that service provider will have to now take 5 registrations. He'll also have to start figuring out his customer, whether it's a local service or an interstate service. So with that, I'm just going to move into what is the impact of GST, so to speak, on manufacturing, trading, and services. Manufacturers today have both excise and VAT. So to some extent, the manufacturing, industry is used to both a central and a state levy. And to that extent, it's not going to be such a paradigm shift in terms of administration, while there are important other changes from a supply chain, financial, and operational perspective. Some of you are familiar with excise issues like repacking, labeling. All of those things should be academic going forward. Valuation rules for self-supply, valuation rules for stock transfers, job work. All of these, again, should be a thing of the past, because the taxation event moves away from manufacture and it moves into a tax event of actual supply that gets taxed, and not necessarily each and every self-supply itself. Possible increase in compliance a little bit, not too much. Today, an interstate sale from a factory, you would charge CST 2%, and you would just chase up for a Form C. You don't necessarily see which destination state you're making your sale to, but under GST, you will have to do the billing state-wise and split that to track each and every shipment in a detailed manner. So while on top I've largely mentioned an equal arrow or a neutral arrow, you may notice that there are some elements here that, and while I would say manufacturing is by and large neutral, pricing changes will be there depending on the rate of tax. There will be increase in working capital requirements, as well as we'll need to see how the 1% additional tax pans out. In terms of traders, we should see that, as I mentioned today, when you and I as a customer go and buy the product or we buy the laptop, we don't notice what is the excise duty element. Going forward, excise duty element is a thing of the past. There will be only a GST through the supply chain. So what this means is that purchase cost should go down and credit should go up. So if I'm a trader today, I have a particular store in a mall, I'm not entitled to claim service tax credit on the rent or the service tax on the rent that I pay. Going forward, I can claim credit on service tax or the taxation of services as well. If I incur an advertisement cost, I can't claim it today. Going forward, I can claim that credit. So to some extent, a trader is going to be better off because he's going to be able to claim more tax credits. On the pricing side, I really can't comment whether he'll be completely better off or not, but because that largely depends on the rate of tax. But based on the current rate of tax, and that's why I mentioned that the purchase cost should reduce, at least for normal products or the routine rate, the rate of tax is expected to be at a moderate rate of 18%, and there's a hope and expectation that IT hardware may be at a lower rate as well. Warehousing may still matter if there's a 1% tax, but if the 1% tax goes away, hopefully even that will not matter, and then companies can have their logistics and warehousing depending on where it works best for them rather than only on a 1% tax basis and having, factoring that aspect. E-commerce, without getting into great detail today, the supply chain on e-commerce is largely, is in many cases, I won't say largely, many cases driven by the rate of tax in the origin state. Going forward, the rate arbitrage between two states goes away, should go away, and therefore we should see that e-commerce as well, the supply chain should be a little more simpler and easier to implement than what we expect, than what we are expecting and experiencing today. Moving forward onto the GST on services, as I mentioned, it's fairly complicated because services today has a rate from 12, which recently moved up to 14, and that's going to expected to move up to say the 18 rate. So one needs to watch what impact that's going to have on an inflationary impact, because let's remember those set of services provided to a B2B customer. Going forward, most of the customers will be able to claim a full service tax credit. So the question of them really losing out of credit doesn't arise. So whether the rate is 12, 14, 18, or for that matter even 20, it doesn't matter because the business gets a whole credit. So we need to nevertheless watch the space, because for those services that are B2C, telecom, insurance, even a normal cab service that you and I avail, all of that will also see an impact of the service tax rate or the tax rate under GST for services. So having said that, while the full credit is available, and I said 18 to 20 should not matter, or 12 to 20 or 12 to 18, but clearly that will increase the credit kitty, but at the same time also increase the working capital requirement of the company. Contracting requirement, I think this is the most complicated one that companies today can perform a service on a pan-India basis, raise one invoice, charge one tax. Going forward, it's going to be a requirement that they have to split their billing for each state from where they perform the service. So to that extent, I think clearly there is a situation where compliance for the service industry is just going to increase manifold. I think the issue that the industry has is that they don't mind doing this multiple compliance, but the question is that how clear is the proxy going to be that if I am doing, say, tax consultancy or IT, implement ERP implementation out of 5 offices, how do I determine local interstate, because it's an intangible service, is something that there's an expectation that there will be a lot of clarity around that. So impact on services expected to be significant and somewhat negative because of the fact that you have more compliances, potentially a higher rate, and splitting of a pan-India contract and slicing and dicing it. So that's why the summary that we put together through with Mate is that we think that there will be a significant impact, and we need to work closely with the government to iron out the creases and see how simple and easy can we make it. So what you really see on this screen is what I would say, what I would summarize as the key takeaways, that you have operational issues, financial and infrastructure, because unlike a normal tax rate change around the budget, it's generally a tax change. GST will change the way you do business. So whether it's on the operational side, on the compliance, whether how you're contracting with your customers, how are you setting up your logistics and supply chain, what happens to your existing credits, right from, all of these aspects together would need a relook for you to be meaningfully, benefited under GST and not, left out amongst the other players who have thought about it and done things better. You will anyway have to do some of this to be tax compliant. On the financial side, you see that the rate of tax going up in some cases, or even if a 2% CST today is replaced by an IGST, while full credit is available, you have an increase in the working capital. You also have increase in credits, and therefore that's something that we will impact businesses in the sense that it's a positive impact. That there's increase in credit, that means that you're moving away what is getting hit in a P&L to becoming an asset. But it's not as simple as that only. Overall, relook would have to be had whether it is on the pricing side and on the costing side, and because at the end of the day, some products, let's say on an IT hardware sector, that I have a fast-moving mobile and it's priced at 19,999, and I know that that price is not so much determined about the cost plus, it's a multiple set of factors, and even if the rate of tax is different from two states, 1% here and there, I still want to maintain that price point. What happens to those particular pricing decisions taken? Because under GST, whether the rate is 18 or whether it's a lower rate, either way, a relook at the costing and pricing is also paramount and important for you to do. Moving forward from a compliance perspective, because many of us, will have a right approach, which is that let the tax planning be done later, but I need to be tax compliant on day one. I need to be able to continue my business on April 1 and not stop my business. So therefore, what do I need to do in changing my IT systems? I need to change, make communications with my employees, with my customers. These are things that need to be done in the run-up, and as any of us familiar with any ERP system, we would be, it's quite clear that any change to an ERP system would take not just few days or weeks, potentially can take several months. And therefore, it's important, regardless of whether we are in the large scale on an ERP or a medium or a small, each one of us will need to relook at the systems and controls and accounting systems that we follow for it to be compliant under GST. So, is it really going to benefit? Or are we talking about old wine in a new bottle? I think before that, it's worthwhile to say that this is probably the largest single tax reform since independence. In the long run, it's expected that GST would benefit all the three real stakeholders, so to speak, whether it's the taxpayers, whether it's the government and consumers, because the taxpayers over a period of time will ensure that all their business expenses, they get credit. Yes, there will be new compliances, but over a time they'll get experience and they'll be able to deal with it. Hopefully there'll be lesser tax litigation on aspects like manufacture, stock transfer, all of that, which takes away a lot of time of some of us involved in this on a day-to-day basis. Reduced tax on the customer, that's really a function of the rate of tax. But I can tell you, based on looking at the economic advisor, chief economic advisor's report, these rates are reasonably good, and if they do come through from a consumer standpoint, I would rather be very happy. And I think that over time the tax burden should be passed down, which comes down, should be passed on to consumers like you and me. Increased revenues for the government with easy administration, yes, that's going to be there, because there's a study that, in fact, once we get into GST, there will be the GDP growth will move up by 1 to 1.5% because there'll be more tax compliance. Companies or business dealers, in the parallel economy will be forced to come into the net. The government will see more tax compliance, and therefore over time there'll be a benefit. I did talk about it, I'm not going to repeat, but service providers will start seeing VAT credit being available. Today, when the server is sold to a service business, the server is used for a business on a B2B, but the buyer cannot claim a VAT credit. So if he's buying the server again at 1 lakh rupees with a VAT of 5.5%, the buyer that says, okay, I am buying it for 1,05,500 because I cannot claim the credit. But under GST, you have a situation where you actually will have the service provider being able to claim credit going forward. So what that means is that he will start looking at that as 1 lakh, and possibly and therefore that 5,500 would be a benefit to him. Traders today cannot claim credit on services that they receive. I did talk about rent, advertising. I'm not going to get into great levels of detail. So in a nutshell, I would say that it's clearly welcome, particularly for the IT hardware sector, and because we did notice that for services sector they may have a set of more complex issues, but while even IT hardware has a host of services right now, whether it's in the form of leasing, AMCs, works, warranties. But on a overall basis, I would say there are better days ahead for us, but we need to ensure that the journey that we run together between now to the introduction of GST is meaningfully managed, so that we are able to manage our business affairs, take business decisions which are tax efficient even going forward, with minimal level of compliance rigor on us. So what are the issues that we can request for? And these are an area that MATE is already actively engaged with. Make in India initiatives to be preserved, have a lower rate of GST, have on ITA products with an HSN based list, so that there's no litigation like it's been in the past. Preserve benefits for STP units so that they can be able, and SEZ, so they're able to get duty-free procurements. Bring out clear guidelines for in-warranty and post-warranty supplies. Abolish the 1% tax. Definition of supply to not include normal movement of goods. Seamless credit going forward. Ensure that the current regime, which has credit restrictions on outdoor catering, rent a cab, things around construction of an office, why should that be denied? Because at the end of the day, if it's a business expenditure, keep the credit restrictions as minimal as possible. Clarity around hardware and software supplies. This is an issue that has been a matter of intense dispute for IT hardware products as well as telecommunication products, because we have software inbuilt on it. What tax rate applies? What proxies of tax will have to be applied on the supply of these products, and ease of movement of goods. Those of us familiar with movement of goods from one state to another clearly understand that it's always been a problem to deal with check post related issues in those states that have a check post. And also we are moving forward. The other set of expectations is to move the credit chain effectively, also transfer the effective dispute remedy, have a meaningful appellate remedy and dispute resolution, and last but not the least, give us as industry enough time to be able to study GST and to be able to meaningfully bring in and be compliant from GST from day one. That's really what I had on on what's a MATE and BMR's perspective. I'm going to pause here and be happy to take questions that you all may have. I have one question on what would the impact of on the IT hardware trading community. I think I reiterate that it's a welcome move even for the trading community, because clearly today when we are trading a product, and if you're trading, say, a product that's even going to go, if I'm selling 100 laptops to a service provider, getting a contract from that customer, he would work backwards, saying my budget is, say, 55,000 rupees, and he would say, I would like to work backward, and you negotiate based on a total landed price. Going forward, you will see more credits to the trader being available on the input side on one breath, and the other breath is the customer will also get the entire GST credit, and therefore he will also welcome GST and say, okay, fair enough, if my budget is 55, then he can pay 55 plus the rate of tax of 18 or 20%, as the case may be. Okay, the next question I have is from Kailash Gupta. Will input credit be possible only by trade organizations or by individuals also? I think the fact is that credit is only available to a B2B on a B2B transaction, and therefore if I as a consumer am buying a product, there will be no credit that I'll be eligible to take. But let's say I'm a practicing chartered accountant individually, I run a service business, then I can claim the credit. But it really, that's more an exception when I, as an individual, are running a business. But an individual for personal consumption, that is what is GST all about. That the chain of tax has to stop somewhere, and it is a consumption-based tax, and therefore the tax that I pay, wearing a hat of a consumer, will not be available as a credit. Okay, I'm just going to read some of the other questions. Would the existing schemes on manufacture find room in excise regime? I do think that the 1% scheme that the government has brought about for mobile phone and tablets, I'm afraid that it's going to be a little complicated for them to continue that under GST in an exemption form. Nevertheless, we should be engaged with the government and ask them for a workaround to see how this benefit basis, which companies have put in crores of rupees in investment, how can we give them some level of benefit even under GST? And I think that's an area that NATE has also been engaged with in the conversations with the government. But on a very technical and theoretic basis, even if you have a lower rate at the time of manufacture, but if the supply chain has a full tax rate, it doesn't really help, because the tax rate, because the lower rate is sort of academic, because once the movement of the product happens to the supply chain, a higher tax rate applies. So we'll have to think and to work with the government to be requesting them to honor this promise of a lower rate in a slightly different manner. At present, we have almost every state having road permit requirement for allowing goods to arrive at their state. Will this requirement of road permit continue or discontinue after GST implementation? So, Dinesh, thanks for that question. I think the fact is that the unfortunate truth is that when GST started off, the thinking there was a consensus among states that we will not bring about we will dismantle the check post, but over time I think it's more wait and watch, because they want to moving completely to a trust-based audit system and relying on companies is something that they're not very comfortable with. I think we will have to gear ourselves up for the concept of waybills and check posts to continue, at least for the first couple of years. I think as industry, we should use this as a point and collectively go as a group and reach out to MATE and request MATE to take up this point as well, to, if not dismantling check posts completely, at least do away with prior obtaining of a road permit. As long as the VAT registration or the GST number is mentioned, that should be enough. Those are things that we should think of and try and go back to the government. The next question is quite similar. That is there a consensus among states for removal of permits? I think unfortunately no. While there is a mention of this, we are actually seeing more states. Yes, the recent past, we have noticed states increasingly getting into e-Sugam kind of declarations and other declarations in different states. And I think that, and we've also had some discussions with some government and policy holders, stakeholders, and they've clearly told us that the states are pushing back a little bit for continuing this, because they would like to see, first how GST pans out. Is there going to be a huge drop in revenue or otherwise, and only then take a bold decision to dismantle. I don't think dismantling would be is on the agenda right now. It was on the agenda earlier. Would input credits be available to trade organizations? I think, again, the trade organization, we need to see, is it running on grants, donations, or is it running on membership? The moment it's running on membership is like a supply of service attracting service tax, and the output, the activity of the trade association will attract the GST on the output side, and consequently they'll be entitled to claim a credit of tax paid on inputs. What is the government's preparation, status of preparation on their IT infrastructure in order to track the GST? We were in a meeting last week with some of the GST and team members in Delhi, and I think that yes, it's fair to say a lot of the government has come a long way on the platform, the amount of time and energy that's invested on that. But I think that, and also there was another comment earlier that states seem to be moving into e-filing and e-permits. So we've seen that states over the last 2-3 years, even the office of GST have moved to a electronic platform for reporting and for all of these sales details to be uploaded. I don't have a concrete answer as to how ready they are. I just think that nevertheless, I can tell you the amount of investment, because they've not yet shared the draft law with us. But if you recall, there were 4 business reports issued a couple of months ago, and that clearly supported, and that was really like a report to this group that was into drafting. And I would think that they are reasonably prepared. I would not say they are largely prepared, but I think the real issue that will come, which we don't have an answer, and I have that as one of the things that we would suggest with MATE will be engaged to find out how, what sort of bandwidth are they creating internally to be able to host all of this data on a pan-India basis. One, also for MATE, our members have written to us and we've been engaged with the government that we don't mind doing all of this electronically, which has to invariably and inevitably happen. But obviously we would request for a clear confidentiality, information being confidential and the data being not accessible. Those aspects be shared with industry at large, that industry has that comfort and not the apprehension of sharing the details that anyway the law will require us to. Can we have a warehouse across the country? The answer is yes, because reduce warehouse to minimum on what count? What is it? I completely agree that under GST, one does not have to look into the concept of having warehouses in each state. So let's rewind. There was the concept of warehouses in 2004-5, before even GST, was that you had a 4% CST, and you would say, look, 4% CST is indeed a significant cost. Let me set up a warehouse in the state that I have a good amount of business, do a stock transfer to that state, and then do a local sale and avoid a 4% tax. When VAT came in 2005, the 4% rate was promised to go down to 0, but we saw it only nudging down to 3, and thereafter to 2%, and it stuck to 2%. So even now, a lot of companies have over the last few years shut down their branches, saying, is 2% justifying the operational and administrative cost to run a warehouse? But now hopefully all of that will be a thing of the past, because if the 1% tax will go away, which is our current expectation, then setting up warehouse will be purely a business decision and not a tax decision. And therefore, to answer your question, clearly, without the 1% tax being there, you would be free to set up your warehouse across the country, not bothering about GST, at all in that decision-making process. Will 1% act as a deterrent for local manufacturing akin to the CST charge when the customer, and he would prefer to import, get a VAT billing? I agree that the 1% has its inherent flaw, that it is anti-Make in India, or in some sense not anti, but the current regime itself has a 2%. And I think that's the government's point, that they're saying that we're not doing something to make things worse. We're getting it down from 2 to 1. But I think the ask of the industry is, why can't you just bring it down to 0 and manufacturing activity right now? If they lose out on any CST, you underwrite that and pay that to that state. I think consensus is building and the 1% should go away. And yes, the current thing, and if the 1% is there, it does act as a small deterrent, so to speak. And I know 1% in some businesses can mean a lot. And therefore, whether it's small or large, let me rephrase that, it would act as a deterrent, small or large, depending on your business. And therefore, MATE's stand has been that we would not like the 1% tax, and we would request for that to be abolished, or in the event it is just going to be there for 2 years, it be honored that it's only for 2 years and not extended any further. Okay, so if there are any other questions, I'll be happy to take that. Otherwise, please feel free to write to me on the email address, or also reach out to MATE. and we'll be happy to
So,
jointly
we can take this
address.
last question, although we are getting a lot of other questions also, but we can take them offline.
I'm sorry, which is the last question, Keshav?
I'm just sharing it now.
Okay, I have one more question from Sheena Khan saying how GST will encourage local manufacturing IT hardware products like a PC and laptop. I think clearly, as mate, we would look forward and support the government's initiative of encouraging us to manufacture. Under GST, what it does, it ensures there's no inverted duty structure. It ensures that any other deterrence of manufacturing in India in the past, where you lose some credit or the other when you manufacture and then supply the goods because you lose out on some outbound freight credit, all of those inefficiencies go away. But will the government be able to do something more than just ironing out the creases and the difficulties that we face vis-a-vis the traders? I think the answer is no. I'm not quite sure. Nevertheless, we have been engaged to see whether we can bring about some scheme. And as you may have read, that NATE is actively involved in discussing with the government and representing for a lower rate on PCs and laptops as well, as they have done in the past for mobiles and tablets. But that is under the current regime. As I mentioned earlier, how will that benefit continue under the GST regime is a question that none of us have a complete answer on, and there seems to be some level of pushback for them to grant us a refund of the tax. Nevertheless, this is one area that MATE has on its agenda in conversations with the government.
Yeah, Mr. Sahib, and we can wrap up now.
All right. Thank you once again to both MATE and the ET Telecom team for having us over. And as I mentioned, please feel free to reach out for any questions that you may have.